Okay, now we're going to turn our attention over to the equity side of the industry. And we've got a really great panel here, and I'm going to just start by letting you guys really steal the show and introduce yourselves.
My name is Sam Guzik. I'm a corporate and securities lawyer. I've been doing it for over 35 years. Based in Los Angeles. I have my own firm, Boutique Corporate and Securities, Guzik and Associates, mostly on the issuer side, mostly on micro-cap, nano-cap, and companies that want to get there. That's what I like to do.
I'm James Riggs. My friends call me Jim. I'm head of investment banking for Maloney Securities. We're based in St. Louis. We have 34 offices around the country. We're one of the larger clearing firms with RBC, and we've recently been very interested in the Reg A space and the Reg A Plus space, which will hopefully be in play very soon.
Yeah, eventually. My name is Steve Sadler. I'm with Allegiancy. We're a pure play in commercial real estate asset management. With the help of Maloney Securities, in April, we completed a $5 million Regulation A offering in hopes of and in anticipation of Regulation A Plus rules coming out sometime ago, in order that we could have done another $20 to $30 million follow-on offering, which we're still working on, but obviously we're waiting for our friends in the government.
I'm Gene Massey with Media Shares. We do marketing for both issuers and brokers. We primarily concentrate on small issuer companies that do their own self-underwritten direct public offerings. We call them now issuer public offerings.
Great. So I guess let's start this one off also with you, Sam, just talking about the regulatory umbrella that is really covering this whole space.
Okay, well, we're gonna focus on what's referred to as Reg A Plus, which is Title IV of the Jobs Act of 2012. The history of this is there's an exemption out there, which is actually, it's called an exemption. Technically, it's a mini registration, which has been around since 1936. I like to refer to it as a one-hit wonder because it really hasn't been used very much. Ben & Jerry's is probably the most famous issuer that's used it, but it's not used. And the reason it's not used is twofold. One is the dollar limitation, which is $5 million. Secondly, more importantly, from my point of view, is even though you go through an SEC registration, you still have to be blue-skied in every state that you sell a security. So unless your business is confined to one or two states, it's pretty much of a not a very useful exemption, and
hassle.
We'll have Steve Sadler will speak to his experience in the last year, but he's looking at the blue sky, and the blue sky he's looking to is Regulation A Plus. Congress finally recognized in 2012 with Title IV that we needed something to rejuvenate the smaller IPO market, which had basically evaporated since the 1990s. There was a time when it was common to see offerings in $25, $35 million that were public offerings. Those have pretty much died. So Congress enacted Title IV, which was basically Reg A on steroids, and hence it's gotten a nickname, Regulation A Plus. Reg A was essentially, it was a reviewed registration. It required unaudited financial statements, simply reviewed financials. So in that sense, it was cost effective. It also had a provision in there for testing the waters, which means a company could go out, solicit indication of interest before it made a filing with the SEC and started spending money on things like accountants and lawyers. What Title IV did, essentially, the most significant thing it did is to number one, it increased the cap from $5 million to $50 million and gave the SEC the authority to raise that amount after 2 years. That 2 years is up. Time flies. The second thing it did, and the most important, is it provided for a full 50-state blue sky exemption. How did the statute do that? In two ways. To qualify for the full 50-state exemption, you either have to go straight to a national exchange, or you have to be what's referred to in the statute as a qualified purchaser. Now, Congress didn't define what a qualified purchaser is. We'll talk about that in a minute. That's probably the main reason why this thing is not at a rulemaking yet at the SEC. The difference between the original Reg A and Reg A Plus is it does require audited financial statements, and it does, unlike Reg A, which basically was opaque, there was no ongoing reporting requirement with Reg A. There is an ongoing reporting requirement with Regulation A Plus. It requires annual financial statements that are audited. Proposed rules were promulgated back in December of 2013. We're still awaiting final rules, put a little more meat on the bones, provided specifically for ongoing reporting that a company who utilizes this new exemption, it's a registration process, must file a 10K, which is similar to 10K, but lighter, a little lighter disclosure, and a semi-annual report instead of 3 quarterly reports, plus some interim reports. So that's basically the disclosure with audited financial statements. There is an initial review process. We'll see how abbreviated it is compared to an S1 that's open to speculation at this point. But the real big thing about Regulation A Plus is when you go effective, you have free trading securities, and that's really a big advantage, obviously, to companies to raising capital. Now, let's just mention briefly, well, I'll talk a little bit later about the blue sky.
Yeah, okay.
Dara. Just one more point. There is a limitation on the number of shareholders of record that you can have before you become a fully reporting company. That's 500 shareholders of record, and I underscore of record because most small OTC companies don't have more than 500 shareholders of record versus beneficial ownership.
So quick question on that. If someone has an SPV and they want to structure it and they have in that a bunch of shareholders, or can they go and invest into, you know, if there's a bunch of shareholders in a fund, would that be counted as one shareholder, or would that be counted as?
They would hold it as record, and that would be a single shareholder. Okay. That's the easy case.
Good to know.
Well, in our offering with Maloney, one of the things that was very helpful there is Maloney Securities investors are all holding the securities themselves in street names. So we functionally have one investor for a $5 million offering. Now that can obviously change, but
How many do you have?
one.
No, I mean,
You mean like little human beings?
In reality, how many
Probably
people?
there are probably about 100 total, maybe a little less.
Pretty complicated to get that process worked out.
So who actually handles all the back office? Is it then Maloney's taking care of it?
Well, there's a trust and transfer kind of thing going on, and then they interface with Maloney. So in terms of paying dividends, and Maloney
It's
does.
a guy named Eddie.
Yeah, Eddie does all the heavy lifting.
It was very complicated, and we actually were perhaps getting ahead of ourselves a bit, but we have an electronic cert at CompuShare who works that part of it, and then we have an independent third party acceptable to RBC that sets the price, which in this case, based on trades, is Interactive Data Corp. So that's how that flows. Okay.
Dara, I think the thing that's interesting to me, the first panel was talking about the debt side, and if you think about the gyrations that we've been through in the last 5 or 6 years, you never hear anybody say, well, gee, that's terrible. That company went under because they had too much equity.
Right.
Right? And so we've had in this country for quite a long time, we've had both a tax and structural advantage to debt and a sort of systemization of debt issuance for small companies. And I think Regulation A Plus and other elements of the Jobs Act really is the first time that we've attempted to deal with that, to bring equity back into the equation. And it's a really important piece of the pie. I mean, it's very difficult as a small company to earn your way into a solid equity position. And for us, raising $5 million, although the process was a bit more cumbersome than we had hoped, at the end of the day, it's dramatically less expensive and less restrictive than bringing in a private equity partner who wants to both beat you over the head and control your stock and take the lion's share of the profit. These are very ugly sorts of partners, necessary in many cases, and we may end up having one if the SEC doesn't do what they're supposed to do. But I think for most entrepreneurs, there's a passion for their business, and that passion drives them to try to take control or retain control and directional, operational control of that company. And Regulation A, and hopefully soon Regulation A+, gives you a mechanism to drive growth for much smaller companies that aren't necessarily poised to be, you know, the angel investors or the venture capital investors' next big thing. You don't have to be the next Google for these types of securities offerings to be beneficial for your company, for your community, and for your investors.
Well, maybe it would be great if you, okay, go ahead, you want to?
Let me touch upon that. I didn't know we're necessarily going in this direction, but as speaking as the firm that injected this equity into Allegiancy, you can't do very much with Reg A. The ceiling's too low. You've got too many costs associated with it. You've got the blue sky, but Reg A plus, as my friend Sam well knows, holds a lot of promise. And the reason we were willing to do Allegiancy was that at $5 million as a Reg A was to show that it could be done. People talked about whether shares are tradable. Well, where are you going to trade them? Well, there was no platform to accept it because you couldn't get DTC to go along with you on this. Without DTC, none of the major exchanges were set to deal with these types of securities, so we had to create our own platform. Now, hopefully soon that platform will be wiped away because when we have these rules finalized, you'll have DTC, you'll have 50-state blue sky, and you'll go to NASDAQ or OTC or a venture exchange. And one of the reasons when I went to New York to talk with some of the top people at RBC, we were able to get them interested in this because they have a venture exchange in Canada and they're familiar with these small offerings. So to my point about Steve's comment, when we get behind an issuer, we understand that issuer. When Allegiancy came out, if you will, or finished with the SEC process, which was very laborious, we could get into that. We had a document that had been vetted by the SEC. We had 2 independent due diligence reports. We had audited quarterly financials going forward. We had a 10b-5 opinion from the law firm. We had a forensic accountant who was going to be our board observer on Allegiancy. We knew when this guy walked down the hall.
Very painful board observer.
So you know it's okay to put where your equity. And fast forward. Therefore, we had no problem creating more demand than there was supply, and we had no trouble trading these securities. Now, we had to do it on a manual basis. It was laborious, but we're able to do it. And if anybody wants to sell Allegiancy shares today, I've got plenty of buyers.
I'd like to say something.
Okay.
One of the things that, I don't know if you mentioned this or not, but the greatest advantage of Regulation A+ is that you can test the waters. I was speaking to one of our key brokers this morning, and he was saying that they just pulled an IPO because there was not enough interest in it. So that means they had gone through the process of the S1 process, the certified audit, getting all their ducks in a row, and discovered there was not enough interest to go forward. And so with the Regulation A+, you're allowed to go out and test the waters and see if you're going to have enough interest to do the offering. And that's probably one of the greatest advantages.
Yeah, let me just make a point. Steve touched on an excellent point, which is really from the company perspective, and I see this when you're a smaller company and you're looking for capital and you go to private equity funds, and it's just very difficult from a company point of view. I mean, they want an arm, they want a leg, they want everything. I mean, they really tie you up to a point where entrepreneurial types are just not comfortable doing business.
Well, and the other side of that too, Sam, is that the private equity guys are looking for such high returns.
Right.
And only a very small number of companies will ever get that hurdle.
Right. The other side of it, though, is there are probably a lot of companies out there that start out that really need that kind of adult supervision that they'll have, with the PE firm. And so one of the the things that I think is really going to accelerate the Reg A+ market, which is going to be out soon, is something called venture exchanges.
Yes.
And essentially, Reg A Plus is a stepping stone for a company. It takes them public, but it's really a stepping stone to a national exchange. And one of the things you have in a national exchange is corporate governance standards. And courtesy of Sarbanes-Oxley, they're too tough. And so people like SEC Commissioner Gallagher, David Wield, who's going to speak, lots of people recognize the need for intermediate exchanges, venture capital exchanges, and what we're going to see in the next year or so is legislation and rulemaking to have the framework to put into place venture exchanges that are geared towards companies that are strong companies, not a good fit for NASDAQ, not a good fit for the New York Stock Exchange, but deserve something better than the bulletin board, which is, you know, nowhere is land and doesn't have a great reputation. So I just wanted to, but that was a great point, Steve.
Well, the other piece that we've thought about a lot, because I think for us at Allegiancy, obviously we're trying to capitalize and grow our own business, and that's our primary focus. But this is a big deal. This is a big deal for our country. This is a big deal for our children. We're looking at a nation that has seen entrepreneurial effort plummet, has seen new company formation for the first time in recorded history, is now declining faster than, or there's more companies dying than there are being started. So the line is crossed and it's going in the wrong direction. And capital is part of that, because if the risk profile, or the risk, I guess, threshold is so high that most people don't see the opportunity to succeed, they don't start businesses. And that means that the next Google or the next Microsoft is probably not getting started. So this is a big deal, I think, in 10 and 20-year time frames, and we need to be thinking about that. It's also a big deal for everybody that's in this business, from attorneys to securities brokers. I mean, you're looking at a marketplace of the privately held companies. The private marketplace is, what is it? It's like 75 times the size of publicly traded companies. So it's an enormous opportunity for investors to get involved and earn solid returns on companies that deliver products to their neighborhoods, to their communities, that employ people that you might know, your husband, your son, your daughter. I have a couple of kids that just got out of college. Job market, not so good. And so there's an enormous impact that we're going to have here with Regulation A+, both immediately for companies like mine, but longer term, I think we have the potential to change the environment so that entrepreneurial activity will once again be flourishing. And the ramifications of that are enormous.
And you make a good point. I mean, this is the private markets. This is where the growth lives now. You know, we saw the chart from earlier for, you know, the Intel's IPO to Alibaba's IPO. This is the opportunities to get in on those Intels.
The things that have happened, there are no more yellow pages. There are no more paper maps. I don't know, Jason was saying he took Uber here today. The taxis are going away, and hotels, I don't know, they'll be around, but everything's changing, and it hasn't fully touched financial services yet, and it will. And it enables you to reach a large number of people. You don't need to call. I joke around and I say a broker calling up somebody and selling stock on the phone is like going door to door with vacuum cleaners. David disagrees with me on that. But I feel that the time will come when everything is going to be on the internet. Everything's going to be bought and sold on the internet, and you wouldn't bother having somebody to call you and tell you about an offering when they can see all of the details, they can see the videos on the company, they can meet the people, they can see the factories, they can see everything they need to see on the internet. I think that's what's going to change everything.
Well, I think you make a good point. I think what's really interesting, and I think what we're trying to do here is combine the regulations and have that meet the technology. And so, you know, with that, you know, we're calling it, you know, this new Reg A, I mean, it's really kind of Reg A meets crowdfunding. So we kind of coined this term, a Rocco kind of new offering, the Reg A crowd-financed offering. And Gene, maybe you could talk a little bit about how to market something like that if you're using technology and you're using online platforms.
Well, the first thing you do is you call your attorney. Because there are so many rules I personally know someone that went to prison. And he's not a great friend of mine, but I know a guy that went to prison. And it's very tricky. You make one little mistake. I tell people there were some guys in Hollywood that decided they were going to do an IPO to raise money for their movie. And during the quiet period, they went on CNN and said, this stock's going to go through the roof. And the SEC shut them down, and their offering never went forward. So if you make one little mistake, even something smaller than that, you can be in a lot of trouble. So, and the rules are very, very complicated about what you can do and what you can say at when and what you can show somebody and how you can show it to them. So the first thing you have to do is talk to your attorney. That said, the time is going to come when you're going to see everything on the internet. You can have now, one way to market an offering now is you can have a live broadcast on the internet. It's allowed. That's how they do net roadshow, and people like that do the online roadshows of offerings, and the time will come when that will be one way. You have to do it live. You can't do it recorded. It has to be live because that's considered to be an oral communication during the offering period. And so that's one way that you can actually market your offering, is have a live broadcast. Once your S1 is effective, you can advertise it essentially anywhere. There's another thing that we got into quite a discussion at one of Dara's events before, and that is suitability. How are you going to deal with that? Well, I talked to a broker this morning about that, and I said, you know, what's this deal on this suitability? And he said, well, the broker is not selling. You're posting something, making it available, and the suitability is in the hands of the purchaser, not of the broker. And explained to me very clearly. Now, maybe Sam can address that, but Sam, if I'm a purchaser of some stock and I maybe don't have a whole lot of money and it may or may not be suitable for me, is the broker still going to be liable for that suitability issue if he's not really selling it? Like E-Trade, you know, you can go on E-Trade and buy anything you want.
I'm not the expert on the broker-dealer side, but just talking very basics here, FIN rules, BD rules. There are suitability requirements for every customer that comes in, for every securities, and when you get down to the higher risk transactions, that's a big issue. If you look at just not really for this panel, but crowdfunding, and there are actually some states that are doing it, and the brokers don't want to touch it for that reason, because it's just the liability is extreme, basically, the way I understand the FIN rules are. For the first 6 months, you're highly at risk. So they don't want to touch it. Now, one of the things I didn't mention about the proposed rules and suitability, at least for the initial offering, is the definition of qualified purchaser, which is what you need to be in a Reg A plus offering to have blue sky exemption. And as is presently proposed by the SEC, anyone can be a qualified purchaser. You don't have to be accredited. But right now, you're limited to what you can purchase in terms of 10% of your net worth, or your income and net worth is exclusive of principal residence. So that's their way of protecting.
Do you know how they're going to verify that?
That's another issue, and all I know is the way they're going to do it is to not, you know, to take people at their word as opposed to over-regulated, because I represent issuers, and the prison they're in is over-regulation, so, you know, by the government. So, but so that's the SEC's approach in rulemaking to suitability, is just limit it to your income, limit it to your net worth, some percentage of it, you know, and require audited financials, require some ongoing reporting, and I think that's a great combination, and at least on the qualified purchase side, which is strictly up to the SEC to decide, they've done a real good job there, because it reduces the risk for the little guy. Now, people have criticized it in one respect, and they're saying, well, accredited investors should be able to invest as much as they want. I totally agree with that. I think the reason that the SEC hasn't done that in the proposed rules were for very technical legal reasons to stay within the mandate of the statute. So That's for a second-level securities law course, but I think the SEC's done a great job with what they had to work to within the statute.
So maybe, it's interesting. I think what really might interest the audience, if maybe Jim and Steve, you talk a little bit about the actual experience in the process of doing it, sort of the offering the traditional way, the roadshow, what kind of marketing that you use to get the deal done, the timing. And then we could talk afterwards, maybe even talk about, wonder what it would be like if we implement a technology component into it and inject that in and see where it goes.
Well, I had been talking with a number of securities attorneys, and they talked about how Reg A was tradable, and I said, well, where are you going to trade it? And nobody could give us a really good answer. And so we got together. It was John Maloney, Don Hancock, Bill Carter, and myself, and we got together, and so we got together and said, we're going to build our own, sell our own, and trade our own, and see what happens. We'll get familiar with the process along the way, and we started this. So we talked to a number of companies, and we were introduced to Steve, and we liked what we heard, and it was something we could understand, and we liked the fact that it was a follow-on offering of 20 to 30 million after we did the 5 once he proved himself. And so that's how we became interested in Allegiancy. And I will talk about the marketing process, because in the absence of DTC, and we didn't have a lot of broker-dealer participation on this first one because they made it so difficult. So we had several signed up for our syndicate, but when it really got down to it, we sold Allegiancy in a few weeks with probably 15 of our best reps, wow. just like that.
Well, and what we did, I mean, our company has participated in Regulation D private placements for a number of years, and so we have some familiarity with how to market and how to package the materials and tell the story. And so we certainly made an investment in building an attractive website and putting together good materials that we thought described our company well and the key players in the company, so that people would have an understanding of who we are and have some of this sort of synthetic internet available presence. They could get a sense for the character of the people behind the organization. And we spent a fair amount of time traveling, talking to broker-dealers and due diligence officers and registered reps, telling the story and trying to help them understand who we are, what we're doing, and where it's headed. And so there was a meaningful investment in that process, and I would encourage anyone who's thinking about doing an offering to prepare yourself to do that. I mean, the quality of your materials tells people something about the quality of your company. And so I would encourage you to plan for that. And then at the sort of, when the rubber met the road and the offering was effective and we could now take orders, what we found was a lot of people didn't believe. They had not imbibed enough Kool-Aid to really sign on to the idea that Regulation A+ was going to be real, and that this process of what we call the democratization of capital was really going to happen. And so we had an awful lot of people who were known to us, known to our firm, as well as known to Maloney. We had an awful lot of people that said, I'm going to kind of watch how this one goes. And so there's a level of...
I've heard that.
Yeah, call it fear. I call it cowardice. But there's a level of caution out there, and people are waiting. And I think one of the things that has impacted us in the last year is the fact that turns out they were right. The SEC wasn't going to do anything, and we are all sitting around still having the same conversation. So we're looking forward to. I think what we're going to see is there's some pent-up demand. There are a lot of people who have been watching that are ready to come in from the sidelines.
I agree with that, and I think Steve and I fundamentally come from a like-minded camp. I disagree a little bit about, you can't have lousy marketing materials, but it differs from the glossies and all of that, because when it really got down to it, our reps sold this off. They believed us, the bankers, and the due diligence and all the things we've done, and they sold this off of a one-page sheet. Talk to their clients.
Did you do a traditional
and they didn't have to fill out a life insurance application, and you didn't have to send them a prospectus. It was an offering circular. It was one page. Thank you. One signature, done.
So, but did you do, was it a traditional like IPO roadshow? Did you go to different cities? Or was it really the brokers manning the phones calling?
Steve did a lot of that, and I think it'll really help us on the next round of 30 million.
Right.
But it really wasn't necessary on 5 million. Now we did have issues with the states. You know, we were trying to get 10 states, and we only got 8, and that was painful and expensive and laborious. So that was again made it a very.
And how long did that take to?
What do you think?
I think from start to effective with the SEC was probably 150 days. We thought it would be more like 90. They kept asking questions, and we kept giving them answers that apparently led them to ask other questions.
Yeah.
So that took a little bit of time. And then in the offering, when we then sent everything out to the states, it was probably another 60 days of arm wrestling. But of course, you're selling in that time period. So,
Right.
And they would come up with knucklehead sort of complaints from my perspective, but.
Yes. Did you? Oh, I thought you had something else.
I just want to chime in on timing here, because you touched on a point which is near and dear to me, which is the frustration of waiting on the SEC. We had a Jobs Act that came out in April 2012. Reg A Plus was dependent upon SEC rulemaking, and the SEC's been dragging its feet, according to some, on a lot of Jobs Act rulemaking. But to the SEC's credit, Title IV was the only provision which was dependent upon rulemaking that actually didn't have a deadline for the SEC to promulgate rules. But notwithstanding that, they got them out relatively quickly, relatively to the other Jobs Act rulemaking in December of 2013.
Yep.
And at least, you know, what I'm hearing with my ear to the ground is it's reasonable to expect final rules by mid-year.
Then I'm gonna differ there, Sam, because I think that you've somehow miraculously, heaven and earth moved, and Congress passed the Jobs Act, which, as I recall, is Jumpstart Our Business.
Yeah.
Jumpstart our business.
Jumpstart
Our business. Startups Act.
Right. So that was in reaction to an economy that was struggling. There is no excuse on God's green earth for the Securities and Exchange Commission to take 3 years to write some stinking regs about a law that already exists.
Yep.
And so they get no quarter from me. I think those guys are part of the problem.
Steve, you're preaching to the choir. If you read my articles, you'll see that there are times in the day that I'm not welcome at the SEC because I've been a critic. But the criticism has gotten overwhelming. But I think finally even people like me got tired of waiting and criticizing. So I think we're all going to be pleasantly surprised in the first half of this year.
And wouldn't the solution just be to maybe just tear up Dodd-Frank and just focus on the Jobs Act? I mean, that would be my suggestion.
Well, you have to get at least 60 votes in the Senate.
So, you mentioned an interesting point, because we're talking a little bit about the liquidity, and maybe Sam, you could also touch on, is there a holding period? How did it work once the investors went in, and how some of them were able to trade, and how you were able to create some liquidity and an aftermarket for this?
Well, I won't speak to the aftermarket. I'll just speak to the legal part, which in this case is really simple. Once you go effective with the SEC on Reg A+, you have free trading shares. So whoever buys in that offering will have free trading shares. The proposed rules also allow, if the company wants, to have selling shareholders included in the registration, so they can sell some of their shares. So, for example, they're affiliates and they have a longer holding period, they can sell some of their shares in that offering. That's contemplated. But I think Jim would be the one to speak to the secondary.
I think I've touched upon that a little bit, because in the absence of DTC playing along with us, the major exchanges weren't set up for this. So we set up our own platform and have a desk to trade these securities, and we do it manually. And we had to get the cooperation of CompuShare, who has an electronic cert. As I said, we had to get the Interactive Data Corp, who sets the price based on trades. And I have trade com firms and statements on my desk, which I'm going to always keep because it was such a laborious process to get it done. And it's complicated. It's not something that just anyone can. You have to have the cooperation from a lot of different people. But again, I'm very hopeful about the future and very much invested in this process and have great hopes for Reg A+.
And then, Gene, maybe could your platform be maybe used as a liquidity engine for
Not
Reg A?
really. No, we're not a broker. We're just helping brokers and issuers market their shares. We don't get a percentage.
platform can't.
We're just hired hands that can help you with your video marketing. But it does bring to light it used to be, and maybe it still is in the real estate business, where the lady would go pick up somebody and go and drive her over and show her the house, and she would maybe like the house, and then she'd drive her over there to show her another house. Those days are gone. In the real estate business, you drive somebody over there after they've seen the pictures, after they've seen the videos, after they know all about the house, where it's located. You can go down the Google street and see where the school is right there. You can see everything you need to know about the house, the price and everything, and finally you go over there and look at it and this may be what the broker's function is. I think somebody said that they were going to do it by October. Is that true?
No, there's no, that's misinformation.
Okay, so anyway, I think Reg A Plus will pass this year. When it does,
you know what I'm talking about.
When Reg A does pass this year, and I like to be an optimist, here's what's going to happen. Well, you mean, that little Reg A Plus thing, you mean I don't have to talk to the states? Well, what about my S1 that's got even more thorough information in a certified audit, and it's been massaged much more deeply than a Reg A+? Can't I be exempt from the Blue Sky merit review also? I think that's going to be a big issue. After it comes out, everybody's going to complain about the requirements for the S1 being exempt from Blue Sky. I think, don't you think so too?
Well, it really has nothing to do with logic. It has everything. It has everything to do with a group I know David Wield is very fond of called NASA.
Yeah.
North American Securities Administrators Association. Yeah. I have a little trouble with that, but it's NASA, and I usually spell that correctly. But I think that's really the issue, and the reason that I think there's been a delay on the Reg A Plus rulemaking is because one of the things that the SEC did with the rulemaking is to get the exemption of the statute, you have to be what's called a qualified purchaser, and that was subject of a lot of debate and behind closed doors lobbying before the Jobs Act was passed, and to the surprise really of everyone, including securities lawyers, the SEC took a very broad stance because people expected qualified purchasers would be accredited investors or something close to that. That's not what they did. Everyone's a qualified purchaser, and NASA has been beside itself ever since, hiring, former SEC enforcement attorneys they've been to numerous meetings in Washington with the SEC. They've got paid lobbyists. I mean, this is their number one issue. Why? Because it's more than the slippery slope. This is well, it's power, but it is all about power. It's about power. It's about revenues, but it's more about power than revenues because they'll get the revenues one way or the other. And David Wield speaks very eloquently on this. I won't get into it. But the point is that qualified purchaser was fought very hard in the legislature. And once that part goes, which hopefully it'll go most of the way with final rules, if not all the way, I think Congress will pick up the slack, and then we're going to start to see the point that Gene's speaking to, which is, hey, you know, what about me with my S1?
That's right.
Because
That's
back
right.
in 96 or 97, Congress passed an act which caused a lot of heartburn to NASA, which basically, you know, had a very, very broad exemption for companies that are exchange listed, but left out the non-exchange listed companies.
right.
And that's the point. That's the area that Gene is speaking to, and that'll be the next shoe to drop. That takes an act of Congress. That will happen as a matter of course. There are other inequities in the bill, not intentional. For example, the companies that already went public and have to file 3 10Qs and a 10K and have rigorous reporting requirements, they say, well, what about us? You know, it's too late for us. And there's one congressman who put in a comment letter to the SEC on that. Those are kind of secondary fixes. I think we'll see on a legislative front slowly moving towards, you know, a better regulatory system. So.
Well, one of the things I think that'll be really interesting to watch as Regulation A+ takes hold and you start to see more companies coming into the marketplace with relatively smaller offerings, I think that Gene's point about marketing is going to be very real, that you're going to see a fairly rapid iteration or an iterative cycle of companies raising capital and streamlining their marketing process, and brokers are going to have to find a way to strip costs out of this stuff. And I think what we're going to see is a meaningful change in the cost of equity capital for small enterprises. And you're going to be moving from 25% cost of capital toward 12s and 15s, where a lot more enterprises will be viable and will have the ability to raise capital to drive the kind of growth that we're all hoping to see. And that takes you back to the marketing materials. I think the definition of who a qualified investor is, those things are all part of that equation.
And I think another point too, I mean, I see we have Zach's investment research sitting in the audience here too, and it's do you think we're going to see or have the potential to see the revival of the small cap analyst, you know, getting back involved in these earlier stage companies, these growth companies?
Be internet bloggers.
Well, I see Howard Orloff in the audience, and I talked with Howard, and he introduced me to Lynn Zaks, and we had a very brief conversation. And one of the things we want to see is for these, we hope that this will be the beginning of an emerging market in U.S. securities. We want the transparency. We want the bad actors away. We want what's right. But when I talked with Lynn, he talked about that he had all these analysts and he wanted to put them to work, and so he'd be very happy to do that. And one of the things we'd like to see when we do Regulation A offerings going forward is some sort of commitment to ongoing analytical coverage, and everything that's there, and they're doing that, and that's exactly what we want to do. And I've been to Chicago. I've met with the head of the microcap space for Zaks. They're very interested in helping us vet deals, find deals, all of those things. RBC is interested. So if we can get the right regulatory environment, I think all of these things will come together, and it can truly be a great day.
Well, and Dara, as you well know, I mean, having an analyst follow these companies and cover them is going to be critically important. One of the dynamics that we have to deal with is the fact of the matter, as a company, as an issuer, I go out and get audited financials. How many of you think of the 100 investors we were talking about, how many of them can actually read an income statement and a balance sheet? I mean, very, very few can actually use that information in any meaningful way. And so having some competent analytical support is going to be important. You know, at this stage for us, I get on the phone and talk to them, and I can walk them through things, and as long as they trust me and believe me, and our performance is reasonably close to what we've been telling them, everything's fine. But if I send a guy 2 years worth of balance sheets and income statements on a GAAP basis, and then of course I have to report non-GAAP because GAAP is a bunch of confusion, now what is he going to think, right? So I think the analytical support is going to be critically important, and that's part of why we have to work on bringing costs down in other places so that we can allocate the monies to pay for those services.
And, okay, go ahead.
Used to be you bought a washing machine from your local appliance store, and you went there because you knew Bill. He went to your church, and you trusted Bill. So you'd go in to ask Bill, what kind of washing machine should I buy? And Bill would say, well, let's hear Maytag. We hadn't had any problems with that, and you trusted Bill, so you'd buy Maytag from him. Today, you go on Amazon and you read the reviews, and the next day it's at your doorstep. And so that's what's going to happen, I predict, with securities. Yes, you'll have analysts, but the crowd will analyze your offering, in my opinion. Eventually, the crowd will analyze it.
May I make a comment to that? Because I was talking to a friend of mine who manages quite a large sum of money for a college. And he wants to see securities that look, he's a CFA and has a staff and they're well trained, that look like things he knows how to review. And we're very interested in having the cost of capital come down. I sat with this guy at lunch, and he has 20 friends around the country that manage enormous sums of money. And we were talking, and the issuer, Steve, he wants his stock to go up because that's how he makes money. I want to do good deals because I want the warrants to be of value. The money managers, they want to invest in things where the securities go up in value. So I view it as we're all pulling the wagon in the same direction. We want to do good deals. We want to have an environment where we can do good deals. And if somebody needs to get out, people die. Kids want to go to graduate school. Things change. They need a ready market so that they can trade these securities based on a reasonable value.
Yeah, I just want to make an observation, it's just, again, touching on the marketing issue. I think one of the things that we're going to see coming out of Regulation A+, when it's effective, slowly, but it's going to build, it's going to have the impact of moving the marketing of these IPOs more onto the internet. It's going to accelerate that process, and I think the way it's going to happen is not through crowdfunding, where people just go on the internet and they get all excited. That's going to be a rare deal. But I think the way it's going to happen is we've got Title II working in the Jobs Act. We've got internet platforms that are doing general solicitation to accredited investors. And I believe once we have Reg A Plus live, those platforms that are broker-dealers or become broker-dealers are going to very quickly want to move into this area because it's bigger dollars potentially than these platforms are doing now in terms of size of deals. And I think you can expect to see them being parts of syndicates and important parts of syndicates that are forming to do these Regulation A+ deals. So I think that's going to be over time transformational in moving a lot of the marketing activity to internet platforms, like we're starting to see in Title II.
That's interesting. We'll probably see a transformation in sell-side syndicates where it's part maybe old school and part, technology. And
well, Dara, isn't NASDAQ's new private markets effort sort of like that? I mean, NASDAQ is now running essentially, it's kind of a closed loop, but a private company can put their securities on that platform for broker-dealers and investors to cross them, creating liquidity in what is not a public security.
Right.
Yeah.
So I think they're seeing some of the same things that we're talking about in terms of the size of that marketplace for private companies. And NASDAQ is coming at it a different way, but I think it confirms what we're talking about here.
Yeah, I don't think NASDAQ's figured it out yet, or if they have, they're just waiting till there's really some meat on the bones or something to chew on. But what they have is kind of a completely different animal right now.
No,
but
I think that's right. It's a different approach.
As venture exchanges come into being, I would expect, I don't know, but I would expect that they'd want to have some place in that.
And with that, we're running over a little bit here. So I know what we'll do is we're going to have a lot of cocktails after the keynote, and there'll be time for plenty of questions and really everyone to get to know each other. That's
yeah, great.
Thanks.
But thank you guys. This was great.
Thank you.